Welcome to this edition of Retirement Crusaders, where I want to show you how to pick dividend stocks. Now, understand that when you select stocks that pay a healthy dividend, these are companies that are mature, or we consider them value companies, meaning their opportunities for growth are limited. So don't expect to buy a dividend stock and see it appreciate rapidly, because they don't have such opportunities for growth. As opposed to a company like Microsoft, which sees lots of opportunities for growth in creating new software and software services, so they don't pay much of a dividend. Why? Because they want to keep the money in the company to invest in these new projects. So you can expect a growth company that pays a low dividend to grow faster, and a company that pays a high dividend to grow much more modestly. So just keep that in mind when thinking about the kinds of investments that you want to select. Now, there's 4 reasons why dividend stocks are really suitable for retirement. Number 1, you get a check every 3 months. So you can either take that check in cash, and that can be part of your retirement income, or if you don't need it, you can reinvest. And most every brokerage company allows you to reinvest your dividends, and they don't usually charge for that service. Reason number 2, dividend stocks return more than other stocks. So here's a bit of research posted by a Legacy Research Group. It actually came from Ned Davis Research and the Hartford Funds, and it shows the S&P 500 history over these was close to about 50 years. And what it shows is this: average annual returns by dividend policy. Non-dividend paying stocks of the S&P 500 produced an 8.5% annual average return, but the dividend paying stocks produced far more, almost 12.8% a year. So we see, at least over this period of time, dividend stocks just produced more total income and growth for investors than non-dividend paying stocks. Number 3, dividends are a hugely important aspect of the total return of stocks in the S&P 500. Now, I'm assuming most retirees or people approaching retirement would gravitate toward the large stocks in the S&P 500. So if we take a look at this chart, what we see is that different decades, and for example, in the decades of the 40s, the total return on stocks was about 10% a year, but 67% of that return was accounted for by dividends. Now, in this period, 2010 to 2020, total return on stocks was looks like it's about 13% a year. It's this left index here, about 13% a year. But of that 13%, only 17% was accounted for by the dividends. Now, why the difference? Because this period from 2010 to 2020 was a period that heavily rewarded growth stocks that didn't pay much dividends. Therefore, dividends were not very important in that decade. Whereas other decades, value stocks, rather than growth stocks, dividend-paying stocks, did much better, and therefore dividends were more important. And if we look at this whole period, what's that, about 90 years, we see that of the S&P 500, total return was about 10% a year, and of that 10%, 42% of it was accounted for by dividends. So dividends are really important part of your total return when you're investing in these S&P 500 more mature, more stable companies. Reason number 4, many dividend companies will also grow your capital. Let's take a look. Here's a chart of Coca-Cola. Let me click on this button, Max, and we can see about 35 years of history, and we see that somebody would have grown their capital nicely over 35 years. And the current yield, if you invest in these shares, is 2.75%. Now, that's not a fantastic dividend in my book. Now, doesn't excite me. This is not a stock I would buy. However, let me just show you this point. If I click on dividends and dividend history and scroll down here, if we go back to, let's say you bought it in 1990, you would have gotten, well, let's do this. You bought it in 2000, you would have gotten 8 cents per quarter. So that's 32 cents a year. And at this point, the stock was trading at about $29. So that would have worked out to not a great dividend, maybe 1.1%. But if you still hold those shares today, you're now getting 44 cents a quarter, or $1.76 per year on that same $29 share. So that's about 6.5% a year. So you see what happens over time if your dividend grows. That's a really great thing. And then if your dividend grows and your stock value also grows, bingo, you've done really great, because you got a nice combination of dividend and appreciation. Now, let me show you a method I used for buying dividend stocks for my clients when I was a financial advisor. In fact, I would create portfolios using 50% of these stocks I'm about to show you and 50% preferred shares. And I have a separate video just about preferred shares. There should be something appearing on the screen right now where you can bookmark that and watch it after this video. So 50% of these stocks, 50% preferred shares. Let me show you these dividend stocks. So you can go to this website, dogsofthedow.com, and there's 30 stocks in the Dow Jones Industrial Average. This method says you buy the 10 of the 30 that have the highest yields. So here's their yields as of today, December 12th, 2022. So you would buy these 10 stocks, and then you hold them for a year. And you come back in exactly a year, and you look at this table again. Now, let's say a year from now, you look at this table, and 8 of the stocks are the same, but let's say Verizon and Dow are no longer there, and there's 2 other stocks in their place. So you get rid of Verizon, you get rid of Dow, and you buy the 2 new stocks. Now you hold those 10 stocks for another year, and you come back, rinse and repeat each year. Very, very simple. And how is this done? Let's take a look. Well, this gray bar shows you how the S&P 500 is done since the year 2000. This is this method I just showed you of buying the 10 stocks with the highest yields. You'll notice that it has outperformed the market, the S&P 500. In addition, not shown on this chart, the volatility of these 10 stocks has been lower than the S&P 500. So your fluctuations up and down have been less. Now, what are these other bars? Well, this bar shows you that if instead of the 10 stocks, you only would have bought the 5 lowest price stocks out of the 10, you would have done even better. And then these other bars show you other permutations if you only buy 7, etc. And you can read all this. But the point is this. This is a methodical system of buying 10 stocks, not having to do anything for a year, coming back, rebalancing your portfolio, coming back once a year, and it couldn't be more simple. Now, I need to mention to you, a lot of people can't even stick to this simple system. So when I was using this for my clients, I would get calls like, oh, I just read a terrible story about Philip Morris and the tobacco and they're being sued, and I see it in my portfolio. Ooh, and I used to tell people I needed to calm down and forget about it. Stop reading the news. Stop watching this nonsense on TV. And sure enough, 3 years later, Philip Morris was up 30% and they raised their dividend. You can't listen to the nonsense in the press or the news. If you use this formula, you use it, you go away for a year, you come back, you rebalance, you go away for a year, and stop watching the news. Now, I'm going to have at least one more video on selecting income stocks, dividend stocks. We'll do at least one video on real estate investment trusts. So be sure to click the bell icon, the subscribe button below, and the bell icon so that you'll get notified if you're interested in dividend stocks. Now, I will be doing a separate video on real estate investment trusts. And the reason they're separate is for this reason. Number one, there are no real estate investment trusts in the Dow Jones Industrial Average. So you get no exposure to real estate in in the Dow Jones average, or in using this methodology I just showed you of picking the 10 highest yielding stocks. Additionally, even in the S&P 500, if you buy an index fund, only 3% of the weighted market capitalization of the S&P 500 are real estate investment trusts. So I'm going to do a separate video because real estate investment trusts are a super, super important segment of the market for retirees because they pay such tremendous dividends. They can be such a tremendous source of income. So that's why we'll do a separate video. Make sure you click the subscribe button below and the bell icon so you do get notified. Also, let me mention something. Below the video in the description, we have some links to a number of booklets that we've created, totally free, on 10 different topics of retirement. Definitely click on those, get a copy, read them. They may be great education for you, and we're happy to provide them. Now, I'm not going into detail today about real estate investment trusts, but I wanted to share this one chart, this one graph with you that's on the Motley Fool site. And they show for the last, about 50 years or so, not quite, the total return on the S&P 500 has been a little over 12% a year. The total return on what's called the NAREIT all equity REITs, so that's all the real estate investment trusts together that invest in property, has returned 13.3%. So this is why I want to do a special video and why this segment is so important. Now let's get to the nitty-gritty of how to select dividend stocks. Now, I showed you one methodology at dogsofthedow.com for selecting the 10 stocks. Here's another site let me share with you. It's called dividendstocks.com. Now, you might like this site. I'm not too big of a fan. Let me show you why. First of all, it's littered with ads. But if I click here under tools, the problem is that it doesn't focus enough. So let me go down here to this link, Dividend Aristocrats. Let me tell you about the Dividend Aristocrats. This is what I said, it's littered with ads. These are companies that have increased their dividend payment for 25 consecutive years, okay? And they're a member of the S&P 500. And so these are considered, real stalwarts of the dividend payers. Here's the problem. Look at this list. It doesn't help you narrow anything down. It's just such a long list that what value is it? What you want is to focus on, 3 or 4 or 5 companies. So let me show you what I do. I go over here to Seeking Alpha. I did a whole video on using the Seeking Alpha service, which I really, really like. There's a link below. By the way, I think at the time that we're recording this, they have, a 3-month or 6-month trial, I think for nothing or for very inexpensively. Anyway, take advantage of it. It's a holiday type promotion, so do check it out. Anyway, oh, and by the way, Seeking Alpha may compensate retirement Crusaders if you use that link. Just want to let you know, full disclosure here. Now, what I would do is, in Seeking Alpha, I can go over here. There's actually a section on dividends, and you could click any one of these. But I'll tell you what, let's do this. I want to go to my search bar, and I want to type in Dividend Aristocrats. Now, I'm just going to select one of these articles. So here, here's a gentleman talking about one of the dividend. This is what I'm looking for, some focus. Out of those 60 or 70 stocks that are dividend aristocrats, I want to see somebody that can focus in, help me on 2, 3, 4, 5 stocks that I should look at. So he's focusing in this article on one stock with an 8% dividend yield, Enterprise Partners. I won't go through the whole analysis of why, but I would invest in this stock right now. Fabulous dividend, fabulous growth possibilities. And the beauty of Seeking Alpha is the following. Number one, I can see that this writer, he has a service called Dividend Kings. He's got 97,000 followers. Right away, that tells me, on Seeking Alpha, that's a very high number, that he tends to be right a lot. A lot of people follow him because he recommends stocks that do well. So that's an indicator right there. But the other thing that I like is if I click here, I see 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 different authors have done an article on this stock. So I get 10 different opinions, 10 different viewpoints, so that it helps you make a really good decision, because some people will be negative. Actually, there's nobody that's negative because these little indicators would be red. So there's 9 people that rated either a strong buy or a buy, and there's one guy that ranks it a hold. And then also we can see that over here, so the Seeking Alpha authors, cumulatively, they rated a buy. The Wall Street analysts rated a buy. And the quantitative ranking is a hold. What does that mean? It means that over the last 5 years, this has been held down because the growth of this stock, the growth, see, there's been like no capital growth, has not been good. These authors explain why they expect that to change and for this appreciation line to head up. But you could read that and you've got 10 opinions to read. So let's just back up for a minute. Again, we go back to this search that I did on Dividend Aristocrats, and now we can pick another. Here's a guy that does an article on, now this happens to be a real estate investment trust. I'm going to cover this in a separate video, but I want you to notice this author has 105,000 followers. I'm not sure that anybody has more than that on Seeking Alpha. Why? Because this guy writes super great articles. He is super sensible, and people have been making money with his recommendations. So, need I say more? Let's just go back and see if there's any other angle of this that we'd like to see. So, bingo. 3M, he's talking about, so here you have articles, but the beauty of these articles is they focus on 3 stocks or 1 stock. And so it helps you focus and select stocks that will be suitable, hopefully, for you. And when you read these articles, from 10 different authors, first of all, this takes you less than an hour. You get 2 things. Number 1, you get a logical view of why you should or should not buy a particular stock. And number 2, you will develop a sense, a feeling like, does this feel suitable for me? Does it feel good? And so you will know in a very short period of time how to select dividend stocks that are not only logically smart, but also feel right for you. That's it today for Dividend Stocks. Tune in, get the subscribe button and the bell icon. We'll be talking more about dividend paying stocks in future videos. We hope to see you soon on Retirement Crusaders.